Welcome back to Algobot, where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm your host here at Algobot, and today we're exploring a price-action reversal approach called Hook Exhaustion Reversal. This strategy watches for a quiet but telling candle, a hook bar, that tends to appear when a stretched move begins to lose its energy. Over the next few minutes, you'll learn how it combines a moving average baseline, the average true range, and a confirmation stop order to fade tired moves in a disciplined way. Remember, this is educational content only, so let's dig in together. Let's start with the big picture. Hook Exhaustion Reversal is a price-action reversal expert advisor for MetaTrader 5. Its job is to fade a move that has become overextended, to look for the moment a stretched trend quietly runs out of steam and lean the other way, but only with confirmation. The central idea is the hook bar. A trend that has traveled too far often doesn't reverse with a huge, obvious engulfing candle. By the time that appears, the turn is usually late. Instead, the market first hooks. It pushes to a fresh local extreme, then loses its nerve and closes back the other way, all inside a candle that is narrower than the one before it. A new extreme, a counter close, and a shrinking range together form a low-energy footprint that wide-bar reversal systems tend to miss, because those approaches demand an expanding range. A hook on its own is just noise, so the strategy adds context. It uses a 50-period exponential moving average as a baseline, and the 14-period average true range as a measuring stick. The hook only counts when price is stretched at least 1.5 ATRs away from that baseline, an exhaustion condition. So the strategy fades a spent move rather than a fresh one. Then it waits for a resting stop order beyond the hook's extreme to actually break before it commits. Who is this style suited to? It's built for traders interested in swing-style reversals on liquid markets. Think major foreign exchange pairs or metals such as gold, on time frames like the 1-hour chart. It's patient and selective by design, standing aside far more often than it acts. As always, this is educational information only, and every trade carries the risk of loss. So how does Hook Exhaustion Reversal actually make its decisions? Everything happens once per completed bar on the primary time frame. When a new bar opens, the strategy looks back at the bar that just closed and treats it as the hook candidate, comparing it against the bar immediately before it. The first filter is range. The strategy measures the height of the candidate bar from high to low and compares it to the previous bar. The candidate must be narrower, by default, at most 90% of the prior bar's range, governed by the NarrowRatio input. This is the quiet loss of momentum idea. A shrinking bar suggests the push is running out of energy rather than accelerating. Next comes context. Using the 14-period average true range and the 50-period exponential moving average, the strategy checks how far the candidate's close sits from the baseline. That distance must be at least 1.5 ATRs, set by the StretchAtrMult multiple. Only a stretched, extended move qualifies, because the goal is to fade something that has already run, not to fight a fresh trend. Then the geometry. For a bearish hook, the strategy signals when the candidate makes a higher high than the prior bar, closes below the prior close, and finishes in the lower portion of its own range, within the close location max fraction, 40% by default, all while stretched above the moving average. For a bullish hook, it detects the mirror image, a lower low, a close above the prior close, a finish in the upper portion of its range, all while stretched below the baseline. When a bearish hook appears, the strategy places a sell stop just beneath the hook's low. When a bullish hook appears, it places a buy stop just above the hook's high, each offset by a small buffer of 5% of the ATR. This is the confirmation step. The market must actually break the hook's extreme before any position opens. If that break doesn't arrive within the entry-expiry bars window, 3 bars by default, the resting order is canceled and the setup is abandoned. Risk is handled purely with the ATR. Once filled, the stop-loss sits 1.2 ATRs beyond the entry, controlled by the stop-loss ATR multiple, and the take-profit is placed at a multiple of that risk, 2 times by default, giving a reward-to-risk of 2 to 1. The strategy holds only one position, and at most one working order, per magic number at a time. A live trade is left to manage itself through its stop and target, and any stray resting order is cleaned up. It's a disciplined, rules-based routine from start to finish. Let's read the strategy in Meta Editor. At the top are the inputs. EMA period, defaulting to 50, sets the baseline. ATR period, 14, drives both the stretch measurement and the risk sizing. Stretch ATR multiple, 1.5, is how far the hook's close must sit from the moving average. Narrow ratio, 0.90, forces the hook to be narrower than the previous bar. Close lock max, 0.40, controls where the close must finish inside the bar. SlATR multiple and TP reward multiple, 1.2 and 2, define the stop and the 2-to-1 target, and entry expiry bars, 3, limits how long a resting order waits. Now the two signal blocks. The bullish hook is a Boolean that's true when the trigger low is below the previous low, the trigger close is above the previous close, the close sits in the upper portion of the range, and the EMA minus the close is at least the stretch distance. When that's true, the code sets an entry just above the hook's high and, if it's a valid stop above the market, calls place stop with a buy stop order, with the stop loss 1 risk below and the take profit at the reward multiple above. The bearish hook is the mirror image. It's true when the trigger high is above the previous high, the close is below the previous close, the close sits in the lower portion of the range, and the close minus the EMA clears the stretch. That routes a sell stop just beneath the hook's low, with the stop above and the target below. Notice that both sides place resting stop orders, never market orders. The break itself is the confirmation. Let's bring the logic to life on a chart. Across the screen, you can see a series of candles with a single smooth line running through them. That's our 50-period exponential moving average, the baseline the strategy calls home. Think of it as fair value. When price drifts a long way from this line, the move is considered stretched, and that's exactly the condition Hook Exhaustion Reversal waits for. Look at the left side of the chart. Price is sliding steadily lower, printing one bearish candle after another, and with each step it pulls further below the moving average. The strategy isn't interested yet. A trend that is still expanding is not one it wants to fade. It's simply measuring how far price has stretched from the baseline, using the 14-period average true range as its ruler. Now watch the candle where the decline pauses. Price pokes to a fresh low, dipping just beneath the prior bar's low, but then something changes inside that same candle. Buyers step in, and the bar closes back up, higher than the previous close, right near the top of its own range. Crucially, this candle is narrower than the one before it. That combination, a fresh low, a counter close, and a shrinking range while price is stretched well below the baseline, is the bullish hook. It's a quiet footprint, not a dramatic one, and that's the point. The sellers who committed at the low are already on the wrong foot. But the strategy doesn't buy immediately. Instead, it rests a buy stop just above the hook's high, then waits. Only if price can actually push back up and break that high does the reversal earn its entry. On the next candle, price does exactly that, climbing through the level, and the buy entry marker activates. A protective stop is set 1.2 ATRs below, and the take profit target is placed at twice that distance. A reward to risk of 2-to-1. From there, follow the candles higher. Price builds momentum, each bar stacking above the last, until it reaches the take profit marker and the long trade is closed for a completed 2-to-1 result. Notice how the entry came not at the exact low, but after price confirmed it was willing to reverse. That confirmation step is what separates this approach from blindly catching a falling market. Now the second half of the chart mirrors the first. Price keeps climbing, and this time it stretches far above the moving average. Again, the strategy waits patiently as the rally expands, measuring the distance from the baseline. Then, near the peak, a telling candle forms. Price pushes to a fresh high, higher than the prior bar, but the buyers can't hold it. The candle closes back down, below the previous close, near the bottom of its own range, and once more, it's narrower than the bar before it. That's the bearish hook, the mirror image of what we saw earlier, appearing while price is stretched above the baseline. The strategy responds by resting a sell stop just beneath the hook's low. If the market truly is rolling over, price should break that low, and on the following candle it does, activating the sell entry marker. The stop is placed 1.2 ATRs above the entry, and the target sits at twice that risk below. From there, price rolls down, candle after candle, until it reaches the take profit marker and the short trade is complete. Both trades followed the same blueprint. Wait for a stretched move, spot the narrow hook where momentum quietly rolls over, require a break of the hook's extreme as confirmation, and manage the position with a fixed ATR stop and a 2-to-1 target. And if that break never comes within 3 bars, the resting order is simply canceled, and the strategy waits patiently for the next opportunity. And that brings us to the end of our look at Hook Exhaustion Reversal. We covered the core idea of fading a stretched, exhausted move, the geometry of the narrow hook bar, the roles of the moving average baseline and the average true range, the confirmation stop order beyond the hook's extreme, and the pure ATR approach to stops and a 2-to-1 target. Hopefully you now understand not just what this expert advisor does, but why each rule is there. Remember, everything here is educational information only, and not financial advice, a recommendation, or a solicitation to trade. If you found this breakdown helpful, please like the video, leave a comment with strategies you'd like us to analyze next, and subscribe for more MT5 strategy walkthroughs. You can find more over at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.